It's 2026. We have phones that can order a pizza while simultaneously filming a cat falling off a chair in stunning 8K resolution. It feels like we're living in the future. And yet, one of the most powerful factors determining your financial future is something surprisingly old-fashioned: your zip code. That's right. The 5 little numbers you write on an envelope can have a massive impact on your ability to get a loan, the interest rate you pay, and even your credit score. It's like your wallet has an unwanted roommate, and that roommate is your address, and it never, ever pays its share of the rent. This isn't some wild conspiracy theory I cooked up after eating a questionable gas station burrito. It's a well-documented, frustrating reality. You could be the most responsible person on the planet. You pay your bills on time, you budget meticulously, you even reuse your tea bags. But if you live in a neighborhood that has been historically undervalued, the system might look at you and say, looks a bit risky. It's financial prejudice by proxy. The system isn't judging you. It's judging your block, your street, and the decades of history baked into the ground beneath your feet. So how did we get here? How did your address become a silent partner in your financial life? The answer, like so many of our modern problems, lies in the past. It's a story about maps, money, and some truly awful government policies. It's a system that was designed, with astonishing precision, to create financial winners and losers based not on their character, but on their location. This system had a name, and it was as blunt as it sounds. It was called redlining, and its effects are still messing with people's money today. Understanding this isn't just an academic exercise. It's crucial because these old rules created invisible barriers that still exist. When a bank decides whether to lend you money, they look at a whole host of factors. But what they might not see, or what they might be indirectly seeing, is the ghost of a racist map drawn nearly 100 years ago. And that ghost is still haunting your bank account. It's time we turned on the lights, saw the ghost for what it is, and maybe, just maybe, finally get it to move out. So, let's talk about redlining. It sounds like a boring term from a history textbook, but it was basically the government creating a how-to guide for financial discrimination. Back in the 1930s, a government agency called the Homeowners Loan Corporation, or HOLC, drew maps of major cities all across America. The goal was to figure out which neighborhoods were safe for mortgage lending and which were risky. They colored these maps to make it super simple. Green was good, blue was decent, yellow was declining, and red, well, red was for hazardous. And what made a neighborhood hazardous? You might think it was things like a high risk of floods, or maybe the presence of a factory that exclusively manufactured banana peels for people to slip on. But no, the single biggest factor was race. If a neighborhood had a significant Black or immigrant population, it was almost guaranteed to get a big, fat red line drawn around it. The official descriptions on these maps were shockingly blunt, often mentioning the infiltration of foreign-born or Negro populations as the primary reason for a hazardous rating. It was state-sponsored racism, plain and simple. This wasn't just some casual recommendation. These maps became the Bible for banks and lenders for decades. If you lived in a redlined area, getting a mortgage was nearly impossible. Lenders would look at the map and say, "Sorry, the government says your neighborhood is too risky for us to invest in." This meant that people in these communities, regardless of their income or how creditworthy they were as individuals, were locked out of the single most important tool for building wealth in America, home ownership. They were forced to rent, often paying more to a landlord than they would have on a mortgage. The effect was devastating and immediate. As investment dried up in redlined areas, property values stagnated or fell. Public services like parks, schools, and even garbage collection often declined. Meanwhile, in the green and blue-lined areas, which were almost exclusively white, home ownership was actively encouraged with government-backed loans. This created a massive, federally funded machine for building wealth in white communities while simultaneously draining it from communities of color. It was a rigged game from the very start. Fast forward a few decades. Redlining was officially outlawed by the Fair Housing Act of 1968. Hooray! Problem solved, right? Well, no, not even close. You can't just undo decades of systemic disinvestment by signing a piece of paper. The damage was already done, and it had set in motion a cycle that continues to this day. The neighborhoods that were redlined in the 1930s are, with shocking consistency, the same neighborhoods that have lower property values today. That's not a coincidence, it's a direct consequence. Think about it like this. If your grandparents were able to buy a house in a green neighborhood for, say, $10,000 in the 1950s, that house could be worth $500,000 or more today. That's a massive amount of equity. It's wealth they could use to send their kids to college, start a business, or pass down to the next generation. That single act of buying a home became the foundation of generational wealth. Now, imagine your grandparents lived in a red neighborhood. They couldn't get a loan. They were stuck renting. They had nothing to pass down. That's not a personal failure, it's a systemic one. This difference in property values creates a huge wealth gap. It's the difference between having a financial safety net and living paycheck to paycheck. It affects everything. Neighborhoods with lower property values have a smaller tax base, which means less funding for schools, roads, and other essential services. This creates a feedback loop. Underfunded schools lead to fewer opportunities, which keeps the neighborhood economically depressed, which keeps property values low. The old red lines on the map might be gone, but their shadow is very, very long. And this isn't just about housing. The lack of investment meant fewer grocery stores, fewer banks, and fewer businesses in these communities. This creates what are known as credit deserts, where people have to rely on predatory lenders like payday loan shops that charge outrageous interest rates. So, even when people in these neighborhoods try to access credit, the only options available are designed to trap them in a cycle of debt. The legacy of redlining isn't just in the past, it's an active force shaping the financial landscape of today. So what does all this history have to do with your credit score in 2026? Everything. Your credit score is supposed to be a simple, unbiased number that shows how likely you are to pay back a loan. It looks at your payment history, how much debt you have, and how long you've had credit. But it doesn't exist in a vacuum. It's deeply influenced by the wealth gap we've been talking about. If you come from a family that couldn't build generational wealth because of redlining, you're starting the financial race several laps behind. Think about the factors that build a good credit score. Having a mix of credit, like a mortgage and a credit card, is good. But if you can't get a mortgage because you live in a historically undervalued area, that's one box you can't check. Having a low credit utilization ratio, meaning you don't use too much of your available credit, is also good. But if you don't have a wealthy family to fall back on in an emergency, you're more likely to max out your credit cards when your car breaks down. Your score takes a hit not because you're irresponsible, but because you lack a financial cushion. This is where the system becomes incredibly unfair. Modern credit scoring models, even though they don't explicitly look at your zip code or your race, can end up perpetuating old biases. They use data that is itself a product of historical inequality. For example, some new models might look at things like your rent and utility payments. That sounds good, but if you live in an area where landlords are less likely to report on-time payments, you get no credit for being a responsible tenant. It's a system that rewards people who are already in the system. Ultimately, understanding this history is critical because it shows us that the credit system isn't as objective as it claims to be. It has a blind spot, and that blind spot is history. Your FICO score doesn't know about redlining, but it reflects its consequences. By recognizing that a person's financial situation is shaped by generations of policy, not just personal choices, we can start to see the cracks in our modern financial systems. And only by seeing those cracks can we ever hope to fix them and build something that is actually, genuinely fair for everyone, no matter what their zip code is. Learn the history, apply the strategy, build the legacy.